Rahul Shah joins us now. Let's take a conversation forward. Rahul, let me start with your view on the market. We've seen a sizable comeback from the recent lows. Will it sustain?
Hi, good morning. I think the things were it. I think we were oversold and the valuations were compelling, and we've seen some, the value stocks bringing back the rally into the markets. So I personally feel that I think still the value stock is leading the markets. So I still feel that there could be a continuation. And if you look at it, I think there has not been a serious FIS numbers in terms of delivery, or if you take domestic, and the markets have just been outperforming if you look at it stock wise, or if you look at, and it's not polarized to one or two stocks like earlier times, and then this time I think if we look at it, it's a full fledged. So I feel that obviously there will be a stock specific which will continue to do well, but I think the markets will continue. I don't see any major downside. If you look at it, 3 4 indicators, I think BFSI space continues to do well, very well, and will do it well in going forward as well. Second, I think auto numbers were good, so I think autos will should continue to do well. Thirdly, I think if you look at the updates from cement, and if you look at the updates from the real estate companies for their quarterly updates, if you see strong demands, which we have said, and a lot of companies have shown as one of the best quarter for them. So I feel that the rally should continue. It might be a phase where after moving around 200 points Nifty line, we might see some consolidation, and then as the Q4 earnings kick starts, and we will see the stocks performing at that point of time.
Okay, that's the take coming in right now on where the market may be headed. Just looking at some of the other, spaces which are going to be in focus, and just analyzing some of the stocks that our colleagues as well highlighted right now. Ashish Kasholia, he's checked in Venus Pipes. There's IndusInd Bank as well, wherein the shareholding disclosure has come out, and the FI holding has been reduced to 63.5% from the earlier almost 66%. Remember, FI investment headroom stands at about 14.19%, and the minimum FI headroom needed for MSCI inclusion is 15%. So the March shareholding details rules out IndusInd Bank's inclusion, whereas the case is only stronger for Kotak Bank to make its entry, and that's why you saw all that excitement on Kotak Bank in trade yesterday. Kunal, this spurt in Kotak that you saw yesterday, does that change the pecking order within banks at all?
So I think ICICI Bank, HDFC Bank would still remain the favorites. Kotak Bank is emerging as a breakout candidate, but then the stock has just shown I think 8% recovery or 9% recovery from the previous lows of 1680, 1660 for itself. So we need to see more levels on the upside for Kotak Bank. Volume participation has had to happen. So this could probably be a bounce at play for the stock price, because looking at the historical charts, the stock has been absolutely sideways. For a trend to emerge, we need the behavior of the stock to change, and that could probably happen once the volumes start to participate quite aggressively for the stock. So we'll get to know possibly in the next maybe couple of weeks or maybe over the next couple of months that whether this is a change of trend for Kotak Bank or just a short-term rally. As of now, I think I would still be bullish on the larger cap names and the more prominent performers, ICICI Bank and HDFC Bank predominantly.
All right. Thoughts as to what you're penciling in when it comes to heavyweight TCS?
I think obviously this quarter remains just to be a challenging for most of the IT companies, and I think the way the global macro is just right now. So my thought process is I think one should look at the what is the quarter-on-quarter growth. What we've been estimating is 0.8% for quarter on year. I think 8.2% year-on-year growth in terms of the numbers. So if we look at it in that perspective, and then we have to look at the management's commentary. So earlier also when I was on the show, I discussed that I think near term, if you talk about 1 or 2 quarters for the entire IT sector as a whole, should be challenging because of the weak macro. But if you have a longer term horizon and the kind of valuations most of the large IT companies are trading today, so it looks quite interesting. So I think near term could be a challenging for the IT companies, and obviously once we see the numbers and the commentary from them, we'll gather more inputs. But what we estimate is I think TCS, Infosys, HCL Tech among the top recommendations what we believe at this juncture of time.
What to your mind is a deserving P multiple for, let's say, TCS and Infosys?
So it's a question mark for me, but in terms of what the market perceives about it. So I feel personally that anything which is less than 25 times, if we look at it forward, then I think it remains a interesting P for these large companies.
5-year CAGR, let's go back to it. The CAGR growth is what I want to focus on. Here's the interesting bit here. 5-year CAGR sales growth for TCS 9%, Infosys 12, HCL Tech lower margin business, Wipro has struggled. Despite a 5-year CAGR sales of 9%, TCS is still a commanding P multiple. The P multiple for TCS is 25 plus. Now, you may look at sales and say, okay, sales is not the only benchmark because you also have to look at margins and cash flows and the buybacks. We add that back. So TCS margins are at 24.5 to about 26%. That's the stated band. But for a company which is growing at 9 to 10%, does it deserve a P multiple of 20 plus when the business per se is contracting, not expanding? So that's my limited point, that while IT stocks may be now nearing that point where they are in and around their 5-year average, but the growth of last 5 years, which includes a COVID uptick, and the growth for next 3 years would be radically different or dramatically different. And that is where I think markets are right now trying to assess that does buying into mid-cap IT make sense or does buying into large-cap IT make sense. One thing I think is very evident, that IT businesses are, in my book, no longer the best linear businesses. They are also cyclical like a lot of other businesses. And that is what I think COVID has only amplified for me, that IT, like any other sector, will go through its peaks and troughs. And that is something which we must recognize. So if there is a cyclicality in the business, why should P multiples be 20 plus? That's the argument which I always have. And Rahul, would you agree with this argument that ultimately it's a cyclical business?
So I think to some extent yes, and some extent no. So if you talk about it, so I think if you look at historically last 10-15 years, where most of the IT companies have grown and they've sustained the kind of valuation what they've got. And going forward also, if we look at it, I think the kind of contribution to the Nifty profits, if you as a universe, if you look at it, so I think they command a huge. And in last 5 years, if you look at it, in the kinds of payouts which have been given from the IT companies, is one side of it. Now, if you talk about the business perspective and the kind of, as you mentioned about cyclical, I would not agree to the fullest extent. Yes, but we have seen the juncture where the IT valuations, markets tend to overbuild it at some point of time. So I think that's the time I think one should look at exiting, but that's a question mark when most of the people don't do it. So, and people get carried away. But if you ask me, it's not a cyclical, but it should be a sustained kind of a business model. And let's not forget, I think if you look at it, I think they have been the most transparent managements, most of the large IT companies, and their commentary, their guidance to the fullest decimal point, what they talk about it. And I think that's what the street likes about it more, about the IT companies.
What about your outlook on Delta Corp? I just want to flag that one off. Came out with its quarterly numbers yesterday. The net profit has seen a growth at about 51 crore rupees, but operationally it's been a bit weak. For instance, the EBITDA has declined by about 12 to 13% to 60 crore rupees. The casino gaming revenue has been decent at about 214 crores. Online skill gaming loss, though, has come in higher at 1.75 crore loss. And you've got the hospitality division revenues, which have grown, but the losses here have also managed to moderate actually to 1.75 crores. Let's get in a view then on the charts, Naresh. Delta Corp, how it's been trending, because it has been a bit of an underperformer for the last 1 year. What are the charts suggesting?
So the stock has been a disappointment in terms of trends. Every time the stock has tried to make a comeback, it has not been able to make a meaningful move above that 205, 210 mark. The last time it bottomed out was in June, July, around that 160 mark. We came very close to it around 175 recently, just a few weeks back. So overall, the trend has been weak. The stock is available at the same price as it was, say, in 2022 and 2021. Even the stock pre-COVID, the stock used to be 220. So the stock has not really recovered post that move of the pandemic. So apart from that, every other name in the theme has done well. So out here, technically 160 to 175 is a very strong support. I would be watching out whenever it starts sustaining about 205. That would be an indication of a trend change. So till that point of time, not really a clear view on the stock.
The two heroes of this week. It was Tata Motors on Monday, Kotak Mahindra Bank yesterday.
So both of them look attractive. Tata Motors specifically looks more attractive on the charts because I would sense, Nikunj, that the auto stocks in the auto sector is making a strong comeback. So, earlier what was happening was, I think M&M was one of the only performers, other than I think TVS Motors or maybe in some phases Escorts, which had done exceptionally well in the second half of 2022. Somehow in the last 2-3 months when M&M started to correct, TVS Motors started to get into a correction, the markets were, or the auto sector was devoid of any major larger cap performance. But I think this time around, you're seeing that change happening for the auto pack. Tata Motors making a strong comeback, Bajaj Auto making a very strong comeback, coming closer to its 52-week highs and I think very close towards its lifetime high levels as well. So that's a positive change for the sector as well as for the stock. Kotak Mahindra Bank, the only concern which I have is the lack of volumes in this up move for the stock price. So if I remove yesterday's candlestick pattern and the volumes, then the volumes have been very average for Kotak Bank in this last leg of this 150 point up move for the stock price. That makes the chart patterns a bit more concerning, that whether the volumes would participate going forward or whether they are waiting for a correction for the stock price. So that's why I would probably wait and watch on Kotak Bank, but I think would be more bullish on Tata Motors.
Okay, that's the view coming in on Tata Motors. But in the meantime, let's also understand the outlook then, Rahul, when it comes to the likes of L&T. Just a short while ago, I was discussing with Nikunj how you're seeing an engineering behemoth hitting a 52-week high. Order book remains resilient. You have also seen the execution that has improved quite significantly, and a lot of their businesses are doing very well. What is this signaling for the capital goods space as a whole, for some of the other smaller players within the sector?
I think if you look at it, one trend is very clear in the markets, which we started with talking about it. One is obviously people are looking at a value stocks, coming back to it. So the growth stocks took a breather if you look at it in such a challenging higher interest rates environment. So my sense is, I think obviously three sectors which outperform in this rally, if you look at it, one is obviously financials, followed by if you look at it, the commodities, a few stocks like cements and all. And third is auto and engineering, which outperformed in this rally. So obviously, what we talk about it, I think after a long time, you've seen most of the capital goods stocks outperforming it. Obviously, primarily the reason being the inherent demand and the capex driven by a lot of companies. So I feel that this should continue to do well. After a long time. L&T has performed, and I think the way the order book is, and usually the Q4 remains good for most of the engineering companies. So my sense is, I think it should do well. We're looking at it, I think it's a conglomerate, and I think Nikunj rightly pointed out earlier, we used to talk about the IT companies which we used to hold, and now we are talking about the entire all core businesses what the L&T is doing. So I think risk versus reward, and if we talk about the the competitors which are there on of the L&T right now, so I feel that it makes a lot of sense having L&T in the portfolio with the good valuations what we're getting at this juncture.
I really see that there is a exciting price trend and volume trend in Zomato. Is it looking strong? I think Nuresh spoke about it yesterday.
Yeah, I think so.
Yeah. Do you track Zomato?
So I do track, but frankly, Nikunj, even the stock in the last, I think, 2 months or 3 months of this expected up move for the stock price, it's been unable to break past above its 200 moving average. That's the first basic criteria which we look out for when we are looking out for big reversals into the stock price trends. And we are talking of reversals as well as time consolidation, which has gone for, I think, one and a half odd year for a stock like Zomato. So, maybe the stock is, I think, 7% or 10% away from those 200 DMAs as of now. The volumes have been just okay for the stock price. I would not say significantly high. Maybe if the stock breaks past about 200 DMA, we could see a complete change of texture in terms of volumes. But I think I'll probably wait out for that confirmation to happen rather than anticipation, because the only concern with anticipating is that maybe the stock may take another couple of weeks or maybe another month or so to break past about those long-term averages. And in that time frame, maybe the other larger cap names could tend to outperform. So it's better to wait on a confirmation rather than anticipation for a stock.
Viresh, you were convinced that Zomato has gone through time-wise and price-wise correction. I think the example which you used, that 1 साल से stock कहीं नहीं गया है.
So if you look at Zomato, say the IPO price was around 70s, the stock went up to 160, corrected all the way down to sub 40 levels, which is a good enough correction for a market say, new age tech companies which have corrected across the world. Now, after making that bottom in May of last year, it consolidated around that 50 mark, then made a new low at 40, where a lot of change of hands happened, huge volumes happened. Recently, in January, February, also it made a low around 45 odd levels. Now, over the last couple of months, the bottom is now at 50. The range upper band is 55 to 57. So we are preempting that breakout because once you've spent a year and a half doing this consolidation, and the base has been hit at least 4 to 5 times over the last 1 year, the base should be ideally strong. If it's not, you'll get stopped out. But a stop loss at 50 gives you a risk of say 6 to 8%. But the upside could be the interim highs which were made in the last 1 year, which was around 70, 75 odd levels. So that gives you a 40% upside also for the stock going forward. So the risk rewards are very interesting. And we've seen this time and again whenever stocks consolidate in this way. You can preempt with a small risk and go ahead, have a view of the next few months. And it could surprise on the upside even with one quarterly results or any good announcement. So positive on Zomato, keeping a stop loss at 50 and playing this out as a risk reward bet.
Rahul, thanks so much for taking time out and joining in, sharing with us your market outlook. A quick check-in on the pre-open rates this morning, and as we speak,